Hello, everyone. My name is Renita Young. I'm a host and broadcast correspondent here at Bloomberg Quick Take Radio and Television. And I am thrilled to be joined today by two investment leaders for a discussion on financing the net zero journey. So please join me in welcoming them to the virtual stage. Andrew Lee, Global Head of Sustainable and Impact Investing at UBS Global Wealth Management's Chief Investment Officer, and Jans Peers, CEO and Chief Investment Officer at Mirova US. But before we begin, a quick reminder to the audience that we want to hear from you. Please send your questions for our speakers by typing them in the white tab to the right of the video window and hitting submit. Now let's begin. I want to start off with both of you. The most recent meeting of global leaders to accelerate action on confronting climate change and promoting net zero emissions was COP26. And so many people hoped it would move the world closer to solving the climate crisis. And so first, Jans, what were your key takeaways from the event?
Sure. To start with any of the COPs before, we didn't expect that, the climate crisis would certainly be solved, in this one. And it took a while for it to get going. But at the end of the day, we got all major economies now committing to a net zero economy and setting, targets from a political point of view. But we also expected that this would be the COP where the private sector would come in a lot more. So we had corporations setting their own net zero targets as well, which were a lot more ambitious than most of the governments. And equally, we've seen a lot more coalitions being formed by the financial sector as well, with asset managers, asset owners, and consultants all forming their own coalitions in climate. One other important topic was that China and US agreed to pretty much fight each other on everything bar climate. So they really want to work together on climate going forward. Which is also setting the framework for corporations to move forward here now as well. And then lastly, we've seen a lot more positive initial evolutions in the battle against deforestation, which also is a major issue related to climate change.
Andrew, same question.
Yeah, no, I agree with many of the things that Jans said. I think, I would say incremental progress, which is great. I think that the collaboration that Jans mentioned, absolutely. And I think the private sector participation in particular, really important. I think one of the things, though, that came out was a little bit of still lots of commitments, and what we really need to see is concrete action and plans to actually fulfill against those commitments. So I think that's something that is going to echo and that we are going to see, in the coming year as we head towards COP27. Really trying to figure out how to close those gaps and make sure that we actually have concrete action to meet the commitments. Deforestation, also agree with. Maybe one thing interesting from a carbon pricing perspective, I think that there was definitely some progress from a global carbon pricing, long path to get there, but I think productive measures, that we reached at COP26. So a lot of good progress, but I think really now it's about action, meeting up against the initiatives.
Now, you did mention, Andrew, that there have been a lot of commitments. For years, there have been several commitments. What do the most recent ones specifically mean to you, the fact that they're coming out?
Well, I think that, what we saw this year and maybe in recent kind of the last 12 to 18 months is a real urgency, right, around the need for action and then the collaboration that we talked about earlier, from all sorts of actors, whether it's governments or asset owners, asset managers. And so a number of the new initiatives that you see in terms of collective across these groups is really important, to see. And so Jans mentioned the deforestation pledge. We also saw a methane pledge, right? We saw action on coal phase down. And while that might have disappointed some people versus the coal phase out expectation, I think it's really important to see all these concrete initiatives. So versus where we were, you said decades ago, I think we are seeing now collective urgency. We're seeing more concrete pledges against all of that. So I think, how do I put it? We're in crunch time, right? And I think that while 2050 is still 30 years away, the interim targets, which I think increased in prominence, are 9 years away at this point. And so people realize they need to have pathways and plans to actually fulfill those commitments. And that's where we are, I think.
We're going to come right back to interim targets, so keep that on the top of your mind. But before we do, Jans, I have to ask you, you said before that people are largely betting on the economy to do the right thing to be able to fund net zero, but you said that there are 4 key steps that are important to consider first. Can you explain them?
Yeah, sure. Well, to come back to your previous question as well, to some extent, there's a lot of initiatives taken and commitments made by, many of the actors in the finance sector. And, Andrew pointed it out as well, we have some time, we're talking about 2050 and an interim target by 2030. And, I really hope that those commitments are not really kind of, just optically made just to buy, some time, I suppose. And if the urgency is really there. And indeed, there are 4 key steps for everybody to go through in that process. And the first step is to really educate yourself to understand, the magnitude of the changes, not necessarily the magnitude of the problem, but really the changes that are needed to actually get to a zero carbon economy, right? The second step is to really, think about what that really means in terms of the implications for the investment patterns. How do you invest? And, like it or not, there will be an element of divestment related to it as well, either by investors themselves, divesting from, the bigger emitters, or by those emitters themselves, like, the energy companies, the heavy industries as well. They will have to divest bit by bit, from heavy emitting assets as well, for both your real emission reasons and potentially stranded asset reasons over long run as well. So that divestment debate will always be part of it. But really, it's more important to invest in solutions as well related to energy efficiency, renewable energy, but also carbon sinks and reforestation, for instance, as well. So we're going to see a shift in that too. A third element is, to have like a real transition strategy as well, but, also rethink the way we measure that. And, this is something that in terms of measurement, specifically carbon emissions and, global warming alignment, those are all metrics that, 5 to 10 years ago, didn't really exist. And we've seen a lot of evolutions there. And, right now, still, at best, the information is incomplete. But we see a lot of great evolutions in the data sector as well to really focus on, developments for scope 3 emissions, for instance, as well, which are really important to understand, and also avoided emissions. So we don't really kind of draw the wrong conclusions. Even if an oil company is saying that they're going to go carbon zero or, to a net zero economy, it basically means that their oil cannot really be used anymore. So even if they pump up oil using wind energy or solar energy, that's not really going to move the needle too much. So we really have to kind of get better data around the total impact of companies' actions as well. And we see great initiatives right now as well. And again, not having perfect data should not be an excuse for not starting today. But there's got to be some change over the next couple of years. And then lastly is engagement, very important as well. Engaging with companies and projects you're investing in to make sure they understand the magnitude of the problem and to see that they really have a transition strategy as well. But just also want to mention that engagement is very important and will be very, very necessary as well to actually make that change happen, but should not be seen as a standalone strategy. It really has to be combined with a divestment and investment strategy as well and good measurement around it.
Okay, well, let's actually take another broader view of this before we do get a little bit more specific. Now, the World Economic Forum says approximately $50 trillion in incremental investments is required by the year 2050 to be able to transition the global economy to net zero emissions and to avert a climate catastrophe. And we all of us talked about the interim targets, which 2030 is just 9 years away. And so to either of you who wants to answer this first, what will drive this near-term emissions abatement? And are asset managers prepared for these commitments?
You want to take it, Jans? You want me to take it?
Yes, sure.
I can jump in first. Yeah. Look, I mean, I think, as you indicated, the science tells us, right, emissions need to be reduced by approximately half, by 2030. So that's 9 years away, and getting to net zero by 2050. And so, what are asset managers doing in terms of preparedness? Jans talked a little bit about the transparency and the data that are needed in order to actually manage portfolios to where they need to get to. I think what's happening right now is that everyone across the value chain, whether it's governments or corporates, asset managers, asset owners, are in the midst of developing roadmaps to actually get to net zero where it makes where it makes sense, given their particular focus or strategy. And so I think, one thing I would say is, it's one thing to get the investment portfolios on the path to net zero, but I think what we need to actually keep in mind that what ultimately matters in the end is the overall world getting to net zero, making sure that emissions do get to that net by mid-century. So I think Jens was starting to get into kind of what are the levers that asset managers have to do or have to pull in order to get to where they need to get to. And I think if I just oversimplify it, I think about overall emissions levels being reduced in portfolios, regardless of what's in those portfolios. And then the second key piece of it being emissions removal from the atmosphere. So I think between those two pieces of it, it's figuring out where in portfolios we can actually utilize to actually get to that stage. So I guess to wrap up, I would say investors in investment portfolios really play a key role on both sides, right? We have to, as Jens was saying, engage with corporates and support corporates with capital, which have clear reduction plans, and then also importantly fund the solutions providers that are actually enabling the solution or the transition away from fossil fuels. So it's a combination of the two in portfolios. And as asset owners think about their overall investment portfolios and getting to net zero, it's about working with asset managers, and it's up to those asset managers to actually provide the building blocks or solutions that enable the building of those portfolios to get to net zero. But again, keeping an eye on kind of net zero and where we're getting to in the real world, as opposed to just in our investment portfolios.
Thank you for explaining that. And so, that kind of begs the question, what other unique ways are asset managers preparing their portfolios to be able to meet those target investments? Andrew.
Well,
not Andrew. Sorry, Jan.
No, Andrew's fine. Go ahead, Andrew.
No, I was going to say, look, some of these I think we've already touched on. I think that when it comes to managing portfolios, first it's about transparency and thinking about the data, understanding where portfolios are. We talked about some of the levers that people have in, depending on strategy, to actually pull to get to net zero, and then it's about working with the underlying portfolios or portfolio companies in order to actually get there. And I think I'm just going to go back to that point about asset managers are a key part of, and investors or asset owners in terms of providing those solutions to get to net zero. And I think it is about the roadmap and an active exploration of how you can set targets, right? And I think that you talked about management of portfolios. It's about understanding where you are and where you can get to. And I don't think that every single investment solution out there can set explicit net zero targets, depending on what the underlying composition and exposure and so forth is. So I think the key thing is when managing portfolios, understanding what that path is, understanding what the implications are from a risk and return perspective, and how that fits into overall investment portfolios, and then contributes to overall net zero targets.
Jens, if you could pick up with some of the options for investing that are very specific, that would be helpful as well.
Sure. But I think, if looking at the different asset classes, there are different options to look at those solutions and divesting or transitioning away from the other areas as well. So on the listed equity space, it's the direct impact, where Andrew was referring to. At the end of the day, it's really important that those underlying companies and projects really have that impact, and not just the portfolio has a specific profile, but we really need to change the world. But we're not, as an equity investor, you're not necessarily financing those companies. You're buying shares from somebody who's basically selling them to you in the market as well. But you're sending out a very strong signal, and specifically combine, COP26 and the willingness for people to finance that climate transition with the new SFDR regulation in Europe. We're going to see a moving away from the wrong areas into the right areas as well over time as well. And that's going to start affecting the cost of capital for companies as well. And that's really going to change their behavior. So, don't be afraid to express yourself on the listed equity side, but specifically on the bond side and on the direct side, that's really where, we can have, the highest impact. And that's where the financing needs are really important. And green bonds and social bonds are really a perfect tool to actually help finance that transition, right? On the direct side, looking at private equity, looking at private infrastructure. So there are many, projects that need financing that relate to financing the transition. So in terms of underlying projects, wind farms, solar farms are the obvious choice, but also reforestation projects, for instance, and investing in real carbon sinks that will generate credits on the one hand, that are really going to suck up carbon from the air over the lifetime of that product that project as well. So those are real options that are available. They're small today, they're niche today, but I expect in the next couple of years that more and more investors are going to focus their attention to that, and more asset managers will offer really good solutions there as well.
Let's switch over to the social cost of climate change. Andrew, you've spoken about this, and you've said that it will be extremely high. So what could be the impact?
Yeah, thanks, Renita. I mean, I think this is a really important issue. I think climate issues and social issues are integrally intertwined, right? And I think there are plenty of impacts, but maybe just to call out a few that, whoever you are within the value chain, we need to consider. First of which is when we address climate change and think about net zero, that means a fundamental reshaping of the energy sector and other sectors, as Jens and I were talking about, over the coming decades, right, as we transition from being fossil fuel dependent to renewable sources of energy. And I think that has real implications for the labor force in oil and gas, coal, and other areas, right, as this actually develops. So if there aren't well thought out transition plans as we make this move, that's going to have meaningful social implications for those sectors that we have to deal with that aren't insignificant parts of the economy. So I think that's one thing that needs to be thought through and considered. I think the second point is disproportionate impact of climate change and moving to net zero on specific regions and countries that are more energy intensive, and thinking about very much the same types of issues and economies shifting their overall sector dependence, thinking about self-sufficiency. So I think we all know that transition is inherently more affordable for developed markets than emerging markets, and thinking about where the funding comes from to make the transition so that, again, as a globe, we overall get to net zero and address climate change in the right way, really important. But again, social implications, economic implications of making that shift. And I think maybe one other thing to mention is, climate migration, which is a piece of environmental migration, and all of the changes that we're seeing happening specific to climate change, which again are falling disproportionately on developing countries. We're seeing, flow, which increasingly I think will continue, of those that are disproportionately affected, whether it's because of resource, whether it's because of the frequency, of extreme weather, driving people, across borders. And so that is going to have, both social implications as well as economic implications that have to be considered. So I think as an investor, but also, other players, governments, NGOs, there has to be thought put towards some of these social implications as we think about climate change over the coming decades.
Another aspect of that could be biodiversity, and we have a question about that from the audience. Someone asks, how does biodiversity and natural capital impact the investor's journey to net zero?
Sure.
Either one of you, feel free to.
Taking it, yeah, great. No, I think, it impacts it in two ways, one on the problem side and the other one on the solution side, I suppose. But deforestation and the way we deal with agriculture and very intensive industrial agriculture, for instance, equally our diets as well, being very meat dependent on average as well, really have a negative impact on, the capability of nature to actually absorb carbon from the air, right? So we can actually move away from, fossil fuels, but you're always going to have some emissions going forward in our economy as well. So we also need to invest in carbon sinks, and what we're doing is quite the opposite through deforestation. So, in terms of natural capital, I think there's got to be a lot more investment opportunities, actually the need for it as well, to continue to invest in reforestation, do it very smartly, but also then related to that, have, more nature-based agriculture going forward as well, and that's where biodiversity options also will come in. But of course, biodiversity itself has is a risk for our economy and for our lifestyle in general as well. So next to climate change, it's a problem on its own.
Another question from the audience says that this is for Andrew. The Article 6 negotiations were a big part of COP26. So what are your views on the role of voluntary carbon markets in getting to net zero?
Yeah, I think they are going to be increasingly important. I think there are a lot of questions that need to be addressed in terms of, credibility of the solutions in the voluntary carbon markets. But I think they will be a big piece of helping people get to net zero. I think I wouldn't want to, suggest that that's a piece of it. But I think that the focus on getting to net zero without hopefully the use of too much offsets over time is really going to be critical from an investor perspective to think about. But whatever can't be naturally reduced out of portfolios, voluntary carbon markets are going to play a key part of that over time.
One thing that we didn't dive too deep into was the fact that this is a risk model that many institutional investors are not that familiar with. So what types of risks do you see these investors that they should be aware of, rather, and what actions should they take to prepare for them?
Sure. Well, maybe if I can take that one.
Yes, for Jan.
No, I think there's two major type of risk there. One is transition risk, and the other one is more event risk. Starting with transition risks, again, you can look at three levels. You can look at it from a company's point of view. If your business model is not aligned, with that road to a net zero economy, ultimately you will lose market share. You may lose business. You may be out of business over time as well. And in some cases, some companies, even if they are taking the right measures, they may have so many stranded assets that they can actually not move away in time from that. So either way, that may be a risk, even if you're taking the right action. Think about some of the fossil fuel companies, basically, that may not find buyers for their assets, and those assets are actually still having a relatively high price in their valuation today. And another element of the transition risk is governments as well. So we talked about the social impact and also the potential loss of jobs if you move away from fossil fuels to other solutions that are more low carbon in nature as well. And that's also one of the reasons why many politicians still support the fossil fuel economy to that high extent as well, because it's a lose of votes and potentially many people actually having over the short term their lives being affected as well. But by not changing in time as an economy as well, you also run the risk that your economy is not going to be solid in 10, 15, 20 years time as well. So that may lead to a worse competitive position as a country, and equally for the companies active in your country then as well. So that's also really an important part of that transition risk. On the event risk, of course, you have the consequences of climate change. If you have a higher risk of hurricanes, and as a company you're exposed to those areas, for instance, of course that's a risk, high risk of flooding. But then you also have that immigration risk over time. That's part of the transition risk, but also the event risk to some extent. All those factors can really play a very important negative role over the short and the long run for those companies. So what actions can you take? First, again, you understand the problem when you're analyzing a company or a project. Make sure that you understand that. Secondly, engage with the company to make sure that, or the project, to make sure that they have that transition properly. I wouldn't say it's fully under control, but properly managed. And if they don't, really through your voting, make sure that, let's say you use that voting power to, worst case, vote a board out and replace those people then by people that actually have that transition better in mind.
Maybe just to add a different type of risk on top of that from an asset owner or investor perspective, just thinking about, these are different ways of managing portfolios on a forward-looking basis, than we've had in the past, right? And thinking about managing to carbon budgets, right, or forward carbon scenarios. I think that's a very different thing over, decades, right? And thinking about those types of approaches is a little bit different. So, as we transition to thinking about how to position investments for the forward 10 and 30 years, it's a different risk return paradigm when we think about also managing to a carbon or climate objective.
Interesting to note that, Andrew. And so, Andrew, I want to ask this question to you. What regulatory or reporting trends or changes are asset managers focusing on? This is from the audience.
Yeah, I think that, it's a lot of it right now. I think Jans would agree with me right now. Regulatory is just as important, if not more important, than the investment content itself. And thinking about the regulatory regimes that are emerging and with a focus broadly on sustainability, but also specific to climate reporting. This is becoming incredibly important for everyone: asset managers, asset owners, investors. And so I think it's important. I think we need to think about global collaboration amongst those, or thinking about how to meet for global investors, the standards that are emerging in the EU, in Asia, in the US, and making sure that investments actually match up against or are fit for purpose in terms of both the way that they're managed, but also the way that they're reported on. I think that's important. So, but I think specific to the climate discussion, I think TCFD is a very clear, thing that's emerged to the forefront in terms of consistency of reporting overall. And I think that's an important step forward, that all asset managers and investors are focused on at this point.
Gentlemen, we're about to come to a close in about 2 minutes. So for both of you, we'll start first with you, Jans. We've talked about a lot of broad steps. What should be the very next step toward net zero?
Sure. Well, first, let me come back to what Andrew just said there as well. I would really welcome a global agreement between regulators as well and investors in general to have a framework that will be comparable, but it would be standardized across the whole world to some extent, and still leave room for interpretation. In that respect, I think the first really important step is to really have a roadmap for every investment portfolio in the world to that net zero. And it's a roadmap, so it doesn't need to be perfect today, but really have a step-by-step plan between now and 2030. What's going to be the impact of your portfolio going forward as well? So I think that's got to be a really, really important first step. And also, in that respect, don't let the search for perfection be a blocking point in that roadmap.
And Andrew.
Yeah, I'd agree with all of those things. And I think maybe I'd reinforce the collaboration piece of it, right? So it's asset owners working with asset managers. It's asset managers working with and engaging with corporates, all with the same objective. And I think that's going to be critical to get to where we need to get to over the next 10 and 30 years. I do think that the roadmap that Jans mentioned is critical, right? Whatever role you play, the commitments that we're making, the roadmap to get to those commitments is going to be, ultimately what gets us there. And as we've mentioned before, it's really action that matters. And at this point, we're in crunch time, so it's the action that matters, not so much the commitments.
Well, gentlemen, that is a great place to leave it. It's all the time we have. Andrew, Jans, thank you so much for sharing your insights. It's a pleasure to have you here at the Bloomberg Sustainable Business Summit, Focus on Finance.